I should just, by way of introduction, say that Vivek Paul is the Global Head of Portfolio Research and the UK Chief Investment Strategist for the BlackRock Investment Institute. And Oliver Blackburn is a portfolio manager in Janice Henderson's multi-asset team. And to kick off as a sort of quasi-quick-fire round, if Vivek, I may turn to you first and just ask, what do you think is going to be, if you had to pick one, the single most important trend or event that will shape asset prices and the direction of markets in 2024?
Sure. So I think the thing I would call out is the gap between the market pricing of interest rates in 2024 and what the central banks are telling us they're going to do in 2024 and how that resolves. And I think that is the thing to look at and to watch out for, because I think there's a lot that underpins that in terms of the potential market volatility that we could see or could not see, and whether or not markets wake up to the notion that, we've been saying for a little period of time, that we are in a bit of a different environment now relative to the past. So one of the outcomes here is that effectively that we wake up, I guess, collectively to the notion that this is a different regime, a different environment, and the amount of market rate cuts that are priced in, and more have been priced in overnight, are likely to not transpire, and that would lead to a challenging environment for high-level macro volatility. So I think seeing how that pans out, seeing whether or not we're kind of looking at purely cyclical near-term dynamics or actually acknowledging a broader structural phenomenon, which is we believe, for instance, neutral rates will end up higher than we've been used to for a period of time. I think that's a key thing to look out for.
Thanks very much. And Oliver?
So I think the one trend that, if I had to pick one out of the multitude that are likely to be there, is going to be really around that sort of lagged effects of monetary policy tightening, and how that's going to feed through, particularly into corporate and consumer debt markets. We've seen a rapid change in interest rates, and it doesn't really feel like that's fed through yet. If you look back through history, it's generally taken sort of 2 years or so before we really start to see the full effects feeding through into default rates. If you look back and interest rate hiking cycle started in late 2021 or early 2022, we're now 2 years out from that, and that tends to be, as I say, the sort of rule of thumb. We should see probably going to see further rises in default rates through 2024. We've already seen some increase in the high yield markets, more meaningfully in the loans markets, where you get that more rapid feed through of floating rate interests to those costs feeding through to borrowers at a faster rate. And we think that will remain a theme that's very difficult for credit markets next year. If you look at credit spread pricing at the moment, we're really at quite a tight level given the sort of downside risks that could come with them.
It's always great when you kick off with a politician, so with all the animal spirits, ending on a note of kind of relentless optimism, and get straight into default rates when the fund managers hit the stage. Seema Shah, welcome. Seema is the Chief Global Strategist at Principal Asset Management, and I said that you sent me a message saying running, and you were definitely in the window of fashionably rather than terrifyingly late. So don't worry at all.
My apologies.
But if we could turn to you, the question was, if you had to pick one, what's the big trend or the event that will shape markets next year?
Hey everyone, sorry for being a few minutes late. Okay, so this seems a little bit redundant after yesterday's FOMC meeting, but I do think that the pivot is the only thing that matters for next year. I kind of agree, though. I do believe that there's going to be an economic slowdown. I think that and again, it depends which country you're looking at. So for the UK, I think there's already feed through from interest rate hikes. For the US, it's still to come. But generally speaking, the consumer is still pretty strong. Strong household balance sheets. If you're going to get rate cuts, even if it's kind of June of next year, which is when we're forecasting, it's still enough time for the market rates to come down. And so for the corporates that are going to be refinancing, which to me is a real risk, if they can refinance at lower rates, they've kind of almost passed through this bridge of higher rates, they've just kind of gone straight through, then I think that they're on a fairly good path. So the important part of next year is that inflation continues to decelerate. You've already seen it come down fairly significantly. I think we were all wrong, it was actually transitory. But from here on, a little bit of economic slowdown will be helpful for inflation, and then you're going to see pivots, and I think it's going to be a pretty good year for markets, actually.
Yeah.
optimism for once.
And I was fairly unlike you to be
It is.
be that optimistic, but
talking about the UK.
there's time. Yeah, we'll get there. I think I wanted to we've talked a little bit about central banks. We'll probably come back to them during the course of the discussion. But just on geopolitics, so next year is the kind of so-called biggest democratic voting event in history. Depending on what you kind of class as an election, there's anywhere between sort of 60 and 76 countries going to the polls, the US and UK obviously, but the EU, India, Mexico, Indonesia, South Africa, Ghana, Russia. The results probably priced in, I would have thought. But it feels like that kind of seismic voting event should be a big deal for the markets. And at this point, I think I wanted to quickly reference some research that we did before this event to allow sort of weak moderators like me things to say. So one of the things that we asked 300 investors in the UK and the US what they thought of the election results in the UK and in the US, and if they thought which of the results, Republican, Democrat, Labour, Conservative, would be most supportive to asset prices in those markets. And in the UK, the most prominent answer was makes no difference at all. And in the US, it was makes no difference at all was pretty much level pegging with Republican, which has been the kind of the traditional answer for which would be most supportive. So, on one hand, it looks as though there's going to be a huge political change next year. On the other hand, investors, at least according to our data, seem to be slightly shrugging their shoulders. To what extent, perhaps Vivek, I'll come to you first, do you think that elections will play a role in markets next year?
So I think the question you've kind of framed is like what the elections themselves, what impact will they have on markets? And I'm going to come to that, but actually I'm always going to try and flip it to some degree because I think that's interesting and it allows for a contrast between the US and the UK. So what impact do markets have on the election? And the reason I want to kind of go in that direction is that I think the UK general election campaign is going to be conducted in the shadow and the overhang of the previous Prime Minister and her brief stint in office. Because effectively what happened then was that the UK woke up to the idea that there's going to be a huge amount of scrutiny on the promises that are made. And I think as a result, you're likely to see this general election campaign sort of fought around about the centre ground without huge extravagant promises being made on either side. I think that's the sort of the market implication of what's going to happen in that campaign. The interesting kind of comparison there is in the United States, where actually, there isn't, it doesn't feel like there's going to be the same debate around, is the debt burden too high, sort of reining in spending, etc. Either side haven't really kind of factored that into their core messaging. So in some ways, the answer of like. Which one will matter more? I think the interesting the dynamic here is that markets are forcing one in one direction and not really having an impact in the advance of the other one, which is, I think, part of the reason why you're seeing that outcome in your survey.
And I don't know whether you've got to build on that, Oliver, from your point of view.
Yeah, I think the point I think we're sort of getting to really here is around the fiscal state and sort of budget deficits. Budget deficits are already quite high. We know that government borrowing is high, and we know that the cost of that is going to rise in the coming years, unless we see a return to very low interest rates. And that, I think, really does limit the scope to which either party in both the UK and the US can really meaningfully change the direction of their economies. Obviously, spending is going to need to rise with inflation, and that hasn't been factored in the UK in many ways. But also in the US, there's increasing concern about the scale of that budget deficit. And you do see reaction on days when we have heavier issuance in markets. It's limited at the moment. If we see extreme promises that seem more likely to come to fruition, that could result in more volatility in bond markets next year. But the sort of institutional commitments, I think, in both countries remains to keep that in check at the moment.
Yeah, so I think from a couple of points. So in terms of our analysis of historic elections, firstly, it shouldn't really have a meaningful impact on markets for a sustained period, right? It only impacts it if you have a fundamental change. And you can see from the previous US election, it was about the impact on fiscal policy and what was the impact on trade policy. Those are the two things that should move markets from a sustained perspective. So on the fiscal side, especially for the US, if we had spoken about 2 months ago, I would have said something very similar, which is, the deficit is very high, the market is very focused on it, so the government is not going to have that much room to spend as much as they would like to going into a usual election. But actually, recently, you have not seen that to be the case. If anything, it sounds like they still want to do something. So I think that there could be at least a knee-jerk reaction in terms of positivity from the market that maybe something is going to be done in terms of fiscal stimulus in the short term, right? Just I think in terms of sentiment. But then if they were to push through with that, then I think inevitably the market triggers do kick in and you do start to see where actual policy loosening becomes a little bit self-defeating. But it's a kind of a topsy-turvy thing. I think for the UK, I think just having some kind of stability and not having that revolving door would actually be a positive, but that seems unlikely. I was in Asia a few weeks ago, and I was there a year ago when the whole debacle with trust was happening, and it was really embarrassing because everyone was like, "Oh, you're from the UK." But I thought this time, okay, great. Look, we've got some stability. I think Rishi Sunak is quite a credible prime minister, and can go there with a kind of less embarrassed this time. And then, of course, in that week, the news about David Cameron came out, and it was not David Cameron. Yes, David Cameron.
Yeah.
Yes, David Cameron came out. And it became a bit of a laughingstock again of what is going on with UK politics. So I do think that from a global investment perspective, what people need to see for the UK is a credible lineup of politicians, that the UK looks like they know what they're doing with regards to their political system, and just some kind of idea of who is a credible prime minister who can stay in office for more than just a couple of months.
So, you managed to remain optimistic for 14 minutes. Well done. And so, actually, you've segued very neatly into the UK. And for those of you who were with us at this event almost a year ago to the day, Seema was on one of the panels, and she described the UK at that point as like Paris, but without the romance. And at the time, Paris, there was the Gilets jaunes, kind of industrial action. The economy wasn't doing too well. There was a lot of strikes. So it wasn't intended as a compliment, I don't think. So, quite simply on the UK, and Seema, perhaps I'll start with you, and then maybe Vivek and Oliver, you could chip in. Will the UK get any better? Will the economy get any better? We've just heard a lot of optimism from the City Minister. Do you share that optimism?
So I spent a bit of time in Paris over the summer, and I think I was a bit unfair to Paris.
Oh.
I don't know. I think that the UK it's certainly been more resilient than anyone anticipated, certainly more than I anticipated, just like you've seen in a lot of countries around the world. But I think that the consensus that I have for the UK is not necessarily cyclical. There are things that are going to pass through from the rate hiking cycle. We all know that. I don't think there's any mystery around that. But from a strategic perspective, I do have concerns about the UK from a long-term productivity growth perspective. I've talked about the political instability, which is never something that international investors want to get involved in, right? That I think is key. I continue to see that from all clients around the world, is that they have got a lot of scepticism about the UK because of the politics. But I think that there is another issue around labour supply, which we've had a huge amount of immigration in the last couple of years. But in terms of people who can actually join the labour supply as working individuals, it is relatively limited to what you've seen previously. So from that perspective, if that were to persist, then you're looking at a tighter labour supply, which would suggest higher structural inflation pressures. So a higher cost of capital for a country which doesn't have much political stability. What is its long-term investment perspectives? We have so many debates internally with the portfolio managers in the US who, keep going on about US exceptionalism. And I keep getting one question from PMs, which is there any time where you think we will invest in the UK, an overweight UK versus the US, on more than just a valuation basis? Is there any kind of time where the fundamentals are going to look more attractive? And I have to say, we struggle to see from a strategic perspective when that would be. So I think there needs to be a lot of investment today into some kind of sector technology which we think will improve growth in the longer term, and currently we're not seeing that.
Vivek, do you share that?
It's actually a lot of overlap in terms of what I'd say. I think the structural dynamic is more challenged in the UK. We've framed this as an idea of like the trade-off that sort of policymakers are making between sort of prioritising growth, prioritising inflation, and because of those structural supply issues being more prominent, I think, in the United Kingdom, we're actually at the apex of that trade-off. And I think that's been more challenging for the Bank of England as a result, and I think that will continue in terms of the near run. The broader point, I think, is that, yes, so valuations look cheap, but people have been saying that for a long period of time. I haven't really been personally of the camp that valuations for cheap were for a long time, because I think we had to adjust to a new level where more of that sort of instability risk was being priced in. I think we're there and then some now. So I think in that regard it's fine. But what's the catalyst for you to kind of be positive? I don't know what that is in the near run. I think I'd share the point that the sort of structural trend growth type numbers that we have associated with the UK are just materially weaker than other major developed market counterparts. And to the point I made earlier, this general election is kind of being fought in general on things that are unlikely to kind of materially change that in the near term.
And Oliver, obviously you can invest, and you do invest across markets. I mean, what's your exposure to the UK, and do you share the view of your co-panelists?
So the UK is a nicer place to hide right now, given some of the characteristics and obviously that lower valuation. So we're maybe not as negative as we are on some of the other markets around the world. A weaker sterling, if we move towards pricing more interest rate cuts, is potentially beneficial to UK companies, given that if you take the FTSE 100, a lot of that exposure is overseas, and that does help you in sort of relative terms. If you're looking at the small cap, I think, or mid cap, I think that's much more challenged at the moment. If you look, we already have weak growth in the UK. We have further pressure to come through from interest rate rises in terms of probably consumer spending, etc., over the next few years. We have an unemployment rate that's already 0.8% off the lows, and any more sort of rise tends to be associated with recession. So you can find a number of sort of reasons why domestic UK exposure is not a good place to be right now in terms of the sort of smaller companies. The larger companies, though, I think you can be slightly more optimistic about them. Cheaper valuations. You have some good sectors there to take more defensive exposure in. I think it's a good mix.
And perhaps Oliver, sticking with you for a moment. I mean, and perhaps slightly back to geopolitics. Another sort of data point in the research that I mentioned earlier on was there is, unfortunately, a lot of conflict in the world at the moment. You've got the Russia-Ukraine war, you've got the conflict between Israel and Hamas, and you've got the kind of the Cold War of US and China tensions. But again, our data points suggested that from a purely markets point of view, not sort of global risk, but market risk, investors expect the impact of those conflicts to be increasingly priced in, and therefore the market risk to decline throughout the year. I just love your thoughts on where you stand on that in particular.
And I mean, this is the question that nobody in sort of investments really wants to sort of get into in some ways, because it's the probabilities around these things are very difficult to weigh up. I mean, you didn't know that there was going to be a conflict in Israel until a few months ago. It was even those who are supposed to be looking at these things carefully in terms of the security agencies didn't seem to understand that. If you are thinking about what the risk is to markets now, I think you can say that we now have two hot conflicts. The violence has already started. The biggest point of escalation has already occurred. That doesn't mean that we can't see further escalation, but it's not something that I think people are is as likely now. The biggest risk event has already occurred. So from that perspective, I think markets are going to become slightly more or less concerned about those. The biggest reaction has already really happened. Points around that sort of Cold War, US-China If it's really that, I don't know if that's maybe too much, emphasising it too much already. But those tensions are going to continue to fluctuate. You've got two superpowers that are increasingly sort of competing against each other. They have very different priorities. But at the same time, I think it's easy to sort of over-egg these sort of tail risks that can come in. I think people put a lot more weight on these than maybe is reality. You can look at what happened with the US and Russia for such a long time, and it never really sort of came into hot conflict. Yes, it came close, but always there was a move away. So I think it's really easy to over-egg the scale of the probabilities of some of these events, and therefore the impact that they're likely to have on markets over the near term.
Anything to add to that?
Yeah. So for the Russia-Ukraine, Russia-Ukraine and also the Middle East conflict. So I don't think you can trade around these things, but I would say that, look, if oil prices are sitting at under $80 a barrel, and if there's any chance of that conflict expanding for next year and oil prices were to rise and then, rise on a sustained basis to above $100, maybe even settling around 115, that would have a meaningful impact on inflation expectations. Typically, inflation expectations follow oil prices. It's meant to be forward-looking. It's actually a little bit responsive. And if you were to see that rise in inflation expectations, then of course it makes the central bank's job a lot harder. So although I don't think you can ever trade on geopolitics, it would be a mistake to. But if I look at the broad scale of risk and how much is priced in, I do think the market is underpricing the potential for higher oil prices and the implications for inflation. It's one of the reasons why I would say that I don't expect a lot of these central banks, I don't expect the Fed to hike in the first half of the year. I think that kind of caution maybe pushes it a little bit further out. So that's one thing. On the US and China point, so I agree. I think it's very easy. We talk about this every year, and it's percolating in the background. For China, or should I say, for the US, I think the risk of a US-China conflict and what the impact is on markets is actually quite small for the US. And the reason is, the kind of key point that everyone's worried about for the US is what happens to technology. It's the biggest sector, it's the most important sector for the US. But realistically, I think that the government there is clever enough to realise that it is such a key part of their economy that there is no point almost biting off their nose to spite their face. So I think that they will have some kind of protection for their technology sector, which then feeds into how they go about the China-US relationship. For China, on the other hand, I think the risks are greater. Because actually, when we talk to, again, investors in Asia as well as anywhere else, the key thing that they're worried about with regards to the US election is what happens to the geopolitical relations. And if you look, again, US clients are worried about investing in China, not just because of the growth concerns, they're also worried about what happens with that US-China relationship. So any deterioration just keeps investors that much further away from reinvesting in the economy, even if there is a sustained upturn.
And Vivek, just on that point, and maybe sort of also layering in another question, these are kind of tail risks that we're speaking about, and to Oliver's point, maybe some of them may be over-egged, but do you agree with Seema, first of all, that the market's perhaps underpricing oil price rises, and secondly, on the topic of tail risks, is there another tail risk that you feel that the market is maybe underpricing?
So I think the general point on trying to kind of position around geopolitical kind of events in advance, I agree with panelists up here that it's very hard to do that. I do think that we can kind of draw some conclusions about a slightly longer horizon, building on some of the points that Seema made actually, which is I think there are implications of this that we can we factor into our more longer run decision making, which is the impact on inflation, for instance, and this is something that we've talked about. One aspect of the answer earlier was that you might see more shocks, which therefore all else equal might mean that the averages that you'd anticipate would be a little bit higher. I would buy that. But also the general point that, for the last 30 to 40 years, we had an environment where there was ever-increasing globalization. And because of the US-China dynamic, that is not where we are, and it's not where we're going to be for a long period of time. So marginal decisions are not all about, if you like, the economy, and they're not about sort of making things cheaper to produce, etc. That has to mean that in aggregate we're making things less in a less efficient way that has to contribute in an upward pressure to inflation. So I think that would be the kind of like something where it's geopolitical led, and I think we can say, in our view at least, that has an impact on markets. In terms of things that that could occur and that we're not kind of factoring in. I think like a broader point here is just like it's linked to my first answer actually in some ways, that the risk is that markets kind of get really carried away with some central narrative in what is still quite an uncertain environment. So when you have a huge amount of consensus, for instance, on 6 rate cuts in the next 18 months or whatever it might be, then the odds of something violent happening as a result of that being unwound by the fact that inflation is sticky or whatever else it might be, that is, I think, the thing to worry about. So the huge consensus in an environment which is more structurally unstable, I think that would be the issue, the risk.
And conscious of time, because we'd like to leave time, obviously, for questions, but risks that we're ignoring to our peril. Any other thoughts on that?
Yeah, I've got, so similar to what Vivek was saying, if you were to see, but mainly with regards to private equity, so one of the concerns that we do have is that, let's say the market is wrong about the pivot next year, and there's higher inflation, whatever happens, and central banks have to keep rates higher for longer, as I had indicated, then I think private equity is definitely a little bit vulnerable. And almost the tentacles of private equity are so widespread that I think that you could be looking at a more financial systemic event. Now, that is not our central scenario. As I said, we are expecting rate cuts next year, but that would be a concern. And one of the two things that we typically think about is, for a worst case scenario for markets, is typically stagflation. Right? Stagflation is worse because it extends, it's very difficult to come out from, and pretty much all asset classes perform badly in stagflation environment. If you compare that to a private equity event, private equity is not as negative as a stagflationary event because it's a quick correction, and typically there'll be so many investors who are willing to buy on those valuations. So that is a tail risk, but it's not as bad as the stagflationary concern that people once had, which I do believe has faded quite considerably.
Oliver?
So I think one of the things that is harder for markets to calibrate is the slowdown in China. We are seeing a different response to previous weak growth in China in terms of the government are not as willing to turn the credit taps on. If you look at the sort of upswings and downswings in global growth and to a certain extent markets over the last 15 years, they've been closely associated with what's been happening with the global, with Chinese credit growth. If we don't get that sort of recovery, how is that going to feed through into markets? And I think this sort of opaqueness around this makes it quite difficult for people to assess. I think the number of linkages around the world that you have to try and think about become quite difficult. And I don't think markets are very good at pricing that. There's all sorts of scenarios that could come out of this. If China doesn't accelerate again around exporting deflation, around the sort of demand side that means for areas such as Europe or the rest of Asia or certain parts of emerging markets that are being heavily dependent on Chinese growth. So I think that's an area that is going to be quite difficult for markets to deal with.
And all that being said, so we've got a quick fire round before we go into questions. So answers of no more than 20 seconds, please. But you can only select one, no hedging of bets, and please be as specific as you possibly can be. If you had to overweight and avoid one asset class in 2024, what would that be? Perhaps, Vivek, I'll start with you.
Okay. I'd be worried about some elements of public credit, IG credit, given where spreads are and given the asymmetries around that. And in terms of the other side, actually, I actually would if for those investors who can operate in this space, private credit exposures, we think there's a structural kind of shift in the market. Future of finance is evolving. There's not without risks, but actually I think spread levels and the sort of structural opportunities that might mean that might be attractive.
Oliver?
So I think the tailwind for the loans asset class is running out. I think there's more credit risk there, and you're going to lose that tailwind that you've had from rising interest rates, and that sort of delayed defaults I think will become an increasing issue there. So that's one that we'd be worried about. On the flip side, in terms of places to be overweight, we're finding really good value in some of the real assets. If you're looking at certain parts of the renewables, infrastructure, specialist parts of property, there's some big discounts there, and you've got some very solid underlying cash flows, whether you're looking at inflation adjusted or just the fact that these are very government-backed cash flows in many cases.
Seema?
So I agree about the loans. On the positive side, I would actually be investing in US small cap equities. I think it's going to have a tough first part of the year as you get a bit of a slowdown, but valuations are amazingly attractive. And if you're willing to sit through some of that volatility, I think the second half of the year is going to be very, very strong.
Great. Well, we can hand over to questions. I think there's 2 mics which will rove around. Anyone want to raise their hand to ask something? Please don't be shy. Anyone? Yes. Sorry. Stephen.
Steve Clapham from Behind the Balance Sheet. I wonder what the panel's thoughts are on the outcome of the election in Taiwan in January.
I don't know.
Yeah, any Thai experts?
That's probably.
Wow. Stand silent. And Stephen, do you have a view? I should ask.
I do have
Okay,
I do have a
did you
view,
hear that?
actually. And funny enough, my podcast, which is out today, James Aitken thinks this could be a really serious turning point, because if the election goes the wrong way, China gets Taiwan by stealth, and then what does the US do? So maybe I should have asked the question, what happens if the wrong person wins the Taiwan election and China is able to acquire Taiwan by stealth?
Okay, I'll take that one. I'll take the bullet. Okay, so when we think about tail risks over a period of years, the one thing that keeps coming up as probably the most concerning tail risk is the kind of the US, China, Taiwan angle. That goes without saying. But we do not anticipate that happening for a couple of years. We do continuous analysis of the concerns around that space because we know it would be very, very meaningful impact on global growth, clearly on markets, you name it, there's a far-reaching consequences, but we are not anticipating that for a couple of years yet.
You can obviously see some sort of feeding through into further US reshoring in certain sectors if that does come to fruition. So again, this could be a factor that helps to boost certain parts of the US, possibly at the expense of Asia. You can see another shift in terms of manufacturing. Obviously, Taiwan's very much known for its highly specialized manufacturing. So you can see some of the consequences from that. If it didn't turn into there's some sort of violence around it, you have to sort of question maybe how much sort of market impact it would have in a broader sense. It could be a more peaceful transition than we might see if it happened in a more violent way. So,
Any views? Nope. Any further questions from the audience? I'm actually staring directly into some light, so I can't actually see very well. Hi, Jonathan, yeah.
Thank you very much indeed, Andy. Can I just ask the panel how they think innovation, most particularly generative AI, could impact the macro outlook over the coming sort of 3 to 5 years, and possibly how it will change how we look at macro outlook going forward in your own firms, perhaps?
Vivek, shall we start with you?
Yeah, absolutely. So when we're kind of thinking about sort of long run structural dynamics, we kind of identify sort of 5 sort of mega forces, we call them, and most of them have the impact. We've talked about a lot of them on the panel already, like geopolitics, aging populations we've not talked about. Most of them have an impact of upward pressure on inflation, upward pressure on rates as a result. This clearly goes in the other direction. So from the macro perspective, I think it's all about like the impact of that productivity gain that is likely to occur. We think that pushes in the reverse direction to all those other mega forces, but at the margin, we think the others win out over the next 3 to 5 years. If I think more broadly in terms of asset pricing, one thing I guess I'd just highlight here, and there's some analysis that we did to try and like look at the impacts of this. It's hard to come up with like some element of like proxy measures of AI more broadly, but thinking about something like patents, patent filing around AI relative to others, you've seen a huge exponential increase in that over recent years, and we think that there is some element of predictive power of that on the broader earnings prospects of different companies if you kind of control for certain variables. I think what that tells us is what we've seen this year has been 7 stocks kind of doing phenomenally well. I don't think it's just that. I think this is a broader economy-wide effect. And actually what's interesting is if you look at the share of those patents, more of them are in the private space than there are in the public space. So I think the effects of this will be big. There'll be more than just 7 names. I think it will have a macro impact. Exactly how that transpires, clearly, we'll have to wait and see.
So I think there's some interesting points around that I would maybe sort of carry forward in terms of some companies that are obviously most clearly linked to this become very expensive, and you've got to wonder how much is then priced in and how much they actually eventually benefit from that relative to the wider economy. This could be a catalyst that eventually actually goes maybe the other way, and you start to see the benefits accruing to more value companies. And if it helps to sort of broaden growth in the economy, maybe actually those who are pushing things forward in that way, actually they don't benefit from it as much maybe as some of the other places that could benefit more because you just not had innovation in many of those value areas. So that could be something that really changes that style dynamic in a way that's maybe unexpected at the moment.
I don't want to repeat what's already been said. I agree entirely. The one thing I guess I would say is when we're thinking about investment considerations for the next 5-10 years, we'll all think about secular themes, but we're trying to find the place that hasn't been tapped yet. And so, if you think about AI, you're trying to find which are the other sectors, the other businesses, which are going to kind of piggyback off the move that we've already had. And so the two that we keep coming to are agribusiness and healthcare. So I think that's where I think you could see still a lot of movement with regards to the potential productivity gain from AI. But that's certainly one of the key considerations from a strategic asset allocation perspective.
And just before we wrap up, we've probably got time for one more question. Anyone from the audience? Then I shall ask it. It's simply we've had it's actually quite strange that we haven't had a proper discussion about the central banking announcements this week, because obviously a bit of a bonanza. The Fed yesterday saying it's over, the tightening period's over, or as good as saying that. And it looks like when you look at sterling, perhaps people betting that the Bank of England will be a slower kind of rate falling. Do you agree? How do you see the ECB, the BOE, and the Fed sort of falling out of lockstep, or do you think that we might surprise to the upside in the UK? Vivek first.
Sure, absolutely. So I'll go back to the point I made right at the start, which was the gap between market pricing and what the central banks are saying. Because the reason I framed it in that way is because what you saw overnight was even though the Fed came closer to the market pricing then moved further still. So I think that dynamic is something that we think that that has to converge in some way. We think that actually you're not going to see all the cuts that markets are currently pricing. And to your point, in terms of a relative story of UK relative to the rest, we do think that there's going to be fewer sort of moves in the United Kingdom relative to the US as a result of this. And you think about that, I guess the primacy of the Bank of England's mandate is all relative to the Federal Reserve. There was a chat from the chair last night around kind of thinking about the growth implications as well. I think the Bank of England don't have to be as explicit about that dynamic. So that's part of the reason why we think fewer in the Bank of England.
Stephen?
Yeah, I agree. I think that the Bank of England will move a little bit later. I think the ECB and the Fed, the ECB certainly in the first half of next year, just their growth story is a little bit concerning. But also they've made amazing inflation progress and it keeps coming down. The Fed around the middle of next year, if not slightly earlier. And then the Bank of England, I do think it's going to be the second half of next year. But the concern that I have for the bank, or around the bank, is that their narrative and their communication is very, very inconsistent. All the nicknames around unreliable husband, unreliable boyfriend, cheating husband, I think those are all apt. It's very, very difficult to read exactly what the Bank of England is intending to do. We can only make the best of what our growth and inflation forecasts are, and those are telling us that we're looking at later in 2024. But I wouldn't be surprised if the Bank of England suddenly decides, okay, we'll just bring it forward. Who knows what they're going to say today? I think they're difficult to read.
Last word on the unreliable boyfriend?
I think we're on a slightly more sort of cautious stance about the economies around the world in general. And in that, I would say more cautious about Europe and the UK versus the US anyway. And you can see that in recent data where the US has remained relatively strong, whereas you can see signs of just continued sort of weakening in Europe and the UK. So I think in terms of relative pricing, you might see the US actually hold up more, and actually the Bank of England might have more to do to come towards where the Fed is at the moment, or that the Fed just backs up. So from a relative stance, I think we're very much sort of thinking about gilts and bonds look like they're better value. We can see how it's more likely that the sort of the US pulls through, and we don't get the sort of more negative outcomes that we just don't think are being fully priced by markets at the moment, or are not being priced in enough in terms of the probable outcomes. So from that sort of perspective, we think we've got the relative, if you're going to bet on sort of certain government bond markets, we prefer to be in the UK and the Eurozone, or the safer part of the Eurozone versus the US.
Well, thank you all. That's all we've got time for on this one. Before I vacate the stage and leave it to my colleague Olivia to come up for the equities panel, I'd just like to say thank you to all the panellists and ask people to join me in showing our appreciation. Thank you.